for joining us today. My name is Dr. Michael Byrne. I'm a lecturer at the School of Social Policy, Social Work and Social Justice in UCD and the director of the Equality Studies Master's programme. I'm delighted to be joined today by some leading international researchers in the area of institutional landlords and the financialization of housing. And I'm sure we have some really interesting presentations to look forward to. I'd like to introduce first Dr. Martine August from the School of Planning at the University of Waterloo, Ontario. And just to mention one recent and relevant publication of many, Martine earlier or in 2020 published The Financialization of Canadian Multifamily Rental Housing in the Journal of Urban Affairs. We also have with us today Dr. Elora Raymond from the School of City and Regional Planning at the Georgia Institute of Technology. And Dr. Raymond also has many publications on this area, but earlier this year co-authored a piece, Gentrifying Atlanta, Investor Purchases of Rental Housing, Evictions and Displacement of Black Residents in the journal Housing Policy Debate. So yeah, some researchers who I think can add a lot to the debate here in Ireland, what we know has been a very contentious debate, and who I'm sure we're all very much looking forward to hearing from. We were due to have Henry Gomori of Princeton University with us, however, yes, there's an issue there. Henry is in the audience rather than as a participant or as a speaker, but we will be able to rectify that during Martine's presentation. So when Martine is talking, I'll rectify that, Henry. There's no panic there. Okay, so here's Henry now. So Henry is I'll introduce Henry now, who's appearing. Henry is thanks, Henry. Technical issues as always. Henry Gomori is a PhD researcher at Princeton University, the Department of Sociology, and a recent publication of his earlier this year, The Social and Institutional Context Underlying Landlords' Eviction Practices, published in Social Forces. So yes, three fantastic speakers, and the running order for today will be divided into two sessions. Our first session will begin with a short introduction from myself. Then we'll have a 20-minute presentation from Martine August and some questions and answers. We'll then have a very short break for coffee or tea, followed by our second session where we'll hear from Elora Raymond and Henry Gomori, and we'll have then hopefully 20 or 30 minutes for discussion and questions and answers, wrapping up then at 4 p.m. The questions and answers are the standard kind of Zoom webinar format. You have your Q&A button at the bottom of your screen there. So if you'd like to ask the question, please fire it in there, and then we will address them at the end of the various presentations. If you are tweeting today, I'm suggesting to use #FinancialLandlords, #FinancialLandlords. So you can use that if you like, if you're tweeting today. Okay, I'm pretty sure that's everything in terms of the preliminaries. I am going to share my screen now and give some brief introduction and context to the issue here in Ireland and the debate. So I'll just go to share screen, and that should be visible there. Okay, so I mean, the Irish context, we know, let's see, this is what's happening here. Okay, there we go. The Irish context, as we know, institutional landlords are new in the Irish context. They were more or less non-existent before the global financial crisis, but have become a significant player in the rental sector since 2014. And we see that in the sharp increase in the number of residential properties purchased by institutional investors each year, which has been growing and continues to grow. And we also see it in the fact that PRS, private rental sector investment, is now the single largest investment asset class within commercial real estate as a whole, which is quite remarkable given how new the sector is. Although institutional landlords represent, in terms of tenancies, quite a small segment of the private rental sector, in terms of new supply and in terms of investment, they're becoming increasingly significant. The drivers of this in Ireland are, many of them are international and are shared by other jurisdictions. In the wake of the global financial crisis, we see the deleveraging of distressed property assets, which created the possibility for the acquisition of discounted housing at a mass scale. And in Ireland, that was subject to quite significant state involvement via the National Assets Management Agency, our bad bank, and the wider state involvement in the banking sector after the financial crash. In terms of housing demand, we've seen a shift with declining access to home ownership. Again, we see this in Ireland and internationally, and a consequent increased demand for private rental sector housing. And then there's the current global financial context, which is characterized by ultra low interest rates and by quantitative easing, which are thought to be some of the drivers of the appetite among institutional investors for PRS property. At a local or national level, promoting the build-to-rent sector and institutional landlords has been an explicit policy objective in Ireland since the publication of the strategy for the rental sector in 2016. And the policy rationale for that is twofold. On the one hand, it is argued that institutional landlords can deliver better outcomes for tenants due to greater professionalism and due to greater stability and security. So that's one set of arguments. On the other hand, it's argued that institutional landlords open up a new and important source of investment, which can support the delivery of much needed housing supply in general and supply of private rental sector housing in particular. But of course, the debate in Ireland has been enormously contentious, and the whole issue of institutional landlords and buy-to-rent housing has been one of the most dominant issues in the debate around housing, and even in just the national political debate in general. And we, somewhat bizarrely, the debate has played out through a series of bird-related metaphors. So there's kind of three positions in the debate. One position argues that institutional landlords are vulture funds because they take advantage and prey on the Irish housing crisis. And this position often points to high rent levels, and sometimes it is argued lower standard rental properties, especially in terms of apartment sizes in the build-to-rent segment. A second position argues that institutional landlords are cuckoo funds because their financial firepower and dominance within the property market means they're squeezing out first-time buyers and creating additional barriers to home ownership. And then a third position says, actually, institutional landlords are swallows whose arrival signals the end of the long winter of the Irish housing crisis and the arrival of a bountiful summer of housing supply. And so the argument here is that institutional PRS housing is particularly well placed to attract international capital and therefore open up an important avenue of finance from the international context flowing into the Irish residential sector. And that supports increased supply of housing in general, and especially the type of housing which it is argued most need, 1 and 2 bedroom apartments in the private rental sector in urban areas of high demand. Finally, there's been some interesting developments from a policy perspective here, and I think this is where Ireland is perhaps ahead of the pack internationally, in the sense that there are some attempts to get to grips at a policy level with the impact of institutional investment on the housing system. A few years ago, back in 2018, the Tyrrellstown Amendment was a piece of legislation which prevented landlords from evicting tenants where they wished to sell 10 or more properties. So it was designed to prevent mass evictions, which was feared to be a potential consequence. And indeed, it was something we saw in practice associated with institutional investment. Then this summer, we see an increase in taxation on institutional investors purchasing single-family dwellings, so houses. And we also see new planning guidelines which are designed to ensure that residential houses are available to purchase by individuals rather than corporate entities. Again, only applies to the single-family dwelling segment. Apartments are excluded from both these measures. The rationale for the exclusion of apartments, unsurprisingly, is that it, as argued by the Minister for Housing, we have a continued reliance on international investment to support the supply of residential apartment housing in cities, and therefore we need to continue to promote institutional landlords. So, I mean, there's an ongoing debate about whether these policy measures are effective or sufficient. But I think it's really noteworthy that all of these policy measures were direct responses to public anger and public controversy around this issue, which I think is something significant when we think about where policy in the area might go and where the politics and the debate might go. So we have a very new phenomenon in Ireland. We have a very contentious debate. We have some interesting developments at a policy level. I think all of this means that it's a really opportune moment for us to plug into some of the international research that is there, especially in contexts like North America, where there is a more substantial body of empirical research looking specifically at institutional landlords, private rental sector, financialization, or multifamily sector, build to rent, these different issues. And that's what we hope to do today, is to use the evidence and the analysis and the insight from the international researchers we have with us, focusing on the North American context, to inform the debate and the policy here in Ireland. So without further ado, I will return to this mode, and I will hand over, if I may, to Dr. Martine August, who will kick us off with her presentation. Martine, if it's okay, I'll let you know after 15 minutes. So when you've about 5 minutes left, if I may. Is that okay?
Yeah, thank you.
Thanks, Martine.
Hi, everybody. Thanks, Michael, for bringing us together today to discuss this topic. I'm going to discuss the financialization of multifamily rental housing in Canada, where this is a trend that's remaking the rental housing sector, and which has serious implications for tenants and for patterns of social and spatial inequality. So I want to start this actually just by looking at one building. This is called the Lord Dufferin Apartments in Toronto, in a neighborhood called Parkdale, where I happen to live. It's a privately owned multifamily building, and like a lot of high-rise rental apartments in Canada, it was built in the 1960s. By the 1990s, it had really just evolved into a de facto source of affordable housing for lower income people. So like a lot of these buildings, you'll find a lot of single parent families. You'll find a lot of seniors who are on fixed incomes, a lot of newcomer households to Canada, people who need lower rent levels. And this building, like a lot of them, was becoming kind of run down. Many landlords were making decent income just collecting rents and allowing these buildings to sort of fall apart, minimally upkeeping them, sort of slumlord style approach to building management. In 2010, Timber Creek Asset Management, one of the largest privately held real estate investment managers in Canada, purchased this property for $5 million over its assessed value. And they began to apply a new style of property management. So they upgraded the building's common areas. You can see they've done some planting out front. put up this sign, redid the balconies. They also renovated vacant suites. Whenever a suite would become empty, they would upgrade it to a condo style quality and then would raise the rent significantly. I spoke to this tenant who told me that she saw her neighbor's unit go up dramatically in price. And she described the way that she saw this neighborhood changing, the building changing around her as longer term residents were being pushed out and newcomers were moving into the building. So these changes at the micro level of this one building are part of a broader shift in the global economy, which is being called financialization. I've got a quote here from Manuel Albers defining what we mean by financialization. It refers to this trend in which finance is taking on a more dominant role in the operations of capitalism. So increasingly, we see money being made through financial investment, which is often speculative, rather than making money through making things or through production. In rental housing, what does this mean? Well, I look at it in terms of the way that financial firms are acquiring rental housing and operating it as a financial product. So the types of firms that I'm referring to here include private equity funds, asset management firms, institutional investors like pension funds or insurance companies, real estate and investment trusts or REITs, and other types of publicly listed real estate companies. So the difference between these types of financial landlords and other landlords is that they acquire properties as investment products for investors. So what does this mean? Well, REITs or other types of funds, investors can buy shares in those funds or they can contribute to the funds. And then the managers of those funds or the REIT go out and buy a whole bunch of rental buildings. And then each month when all of the tenants pay their rent, that income gets divvied out among the investors. So what's happening is that these types of companies are giving investors access to an income stream that's ultimately based on tenant rents. A key issue here is that investors expect a certain return. And the operators of these financial vehicles have a fiduciary responsibility and a personal and financial interest to pursue maximum profits. So they work very hard to extract more value from these buildings and to prioritize higher returns. And this affects the way that buildings are managed, which I'll discuss shortly. But first, I want to talk about how the emergence of these firms in Canada. So in the 1990s, we saw the emergence of this trend. There was a context and we had a very limited supply of housing, very strong demand leading to affordability crisis. And the cause of this in many ways leads back to government policy. And I think you'll notice some similarities here to countries like Ireland and many other places where there's this broad trend in which states have withdrawn from social housing and affordable housing provision, abandoning it to the private market. So in Canada, in 1993, our federal government stopped building social housing. And so the private sector, from that point forward, is the only place people could turn to for rental housing. And then in the late 90s, we saw the deregulation of tenant protections. So this in 1997 in Ontario, Canada's biggest province, new legislation introduced what's called vacancy decontrol. So this allows landlords to increase rents on vacant units by any amount. And what happened was it gave landlords a new incentive to try to make units vacant by removing existing tenants. And this incentive was particularly strong in places where there was a big gap between what like the existing low rent tenant was paying who'd been there for a long time and the potential amount that a landlord could make, particularly in areas that had strong gentrification pressures, if they could get that tenant out and then raise up the rent. So these factors all opened up new potential to profit from multifamily housing. And then financialization offered new ways for investors to tap this potential. In the 1990s and 2000s, a range of new investment vehicles emerged that allowed investors access to multifamily housing. In Canada, real estate investment trusts were enabled by legislation in 1993. In 1997, the first REITs to invest in multifamily housing went public. And this actually coincided with the announcement in Ontario that vacancy decontrol was going to be brought in. So in the past, there were barriers to investing in multifamily housing. You needed to have experience with property management. local knowledge of market factors and these types of things. It wasn't an easy business to get into. Financialization removed a lot of these barriers with new vehicles like REITs that allowed investors to profit from real estate simply by buying shares on a stock exchange. So in a way, you have these new vehicles that are linking groups together, linking together people with money or investors, and then people in this multifamily industry. So this is Daniel Drimmer. He's the CEO of Starlight Investments, which is the biggest owner of multifamily housing in Canada. And he calls his company a bridge between institutional capital and this small potatoes type of owner that, in his words, uses shoebox due diligence. They're so unsophisticated that they would keep their financial records in a shoebox. So Starlight, he's saying, can allow these people with money to acquire all of these shoebox properties in new ways, consolidating a fragmented industry building by building. So how is this consolidation working? Since the late 1990s, financial landlords have increased their dominance in the rental housing sector in Canada. I've demonstrated this by tracking the ownership by REITs each year from 1996 up until 2020. And over this 20-year period, the number of units owned by REITs grew from 0 to over 194,000. So that today REITs own about 10% of Canada's private multifamily housing stock. This is a list of the 25 biggest landlords in Canada. And I've highlighted or made bold the landlords that would be in that financial category. So what you can see is that most of the big owners are financial firms. And if we add up all the holdings on this list, they own 340,000 suites, which is about 18% of the country's multifamily housing stock. And it's also very difficult to figure out who owns what in Canada. We don't have very good data with beneficial ownership. And so I think that the figures that I use are probably major underestimates. I've heard industry estimates of around 20 to 30% right now of multifamily being owned by institutions. This slide shows multifamily properties that have changed hands in Toronto over the past 50 years. And if you look at the portion of the sales that are shaded in black, these are the purchases of suites by financial firms. You can see that they're responsible for an increasing number of acquisitions in recent years. If you look at the year 2020, last year during the pandemic, almost all of the apartments that were bought were purchased by financial firms. So they're really only increasing their dominance during this time of crisis. So why does this matter? Well, it matters because the business models of these firms are based on tenant displacement and dispossession. They call this repositioning, in which they transform a building to be more profitable for investors. So when a financial landlord takes over their building, tenants in each suite are freshly exposed to the logics and practices of finance capital. So we have an image here that I took from an annual report of a company called Main Street Equity. And we can see the financial landlord here imagined as a superhero sizing up all of the ways to profit from this suite. And in the apartment, the money is made when the tenants are dispossessed, either dispossessed of the suite because they're pushed out or of a greater portion of their income. There's two basic ways that these firms can deliver greater returns to their investors from the way that buildings are operated. So first, they can save on expenses. They can do this by reducing their expenses, investing in energy efficiency upgrades, capitalizing on economies of scale, but also by cutting down on maintenance and upkeep and firing superintendents. So you find that some firms really do focus on this strategy, kind of traditional slumlord behavior of not keeping up buildings. The bigger gains are made from driving higher revenues. So these all come from tenants. Firms do this by trying to monetize everything. They charge for laundry, parking, party room usage, storage lockers, sub-metering utilities, just raising fees on all of these things. I was at a conference with financial landlords, and one asked another in the Q&A, can you monetize life security? Which was not a joke. And the answer was, we try to monetize everything. So revenues are also gained through or raised through trying to raise up rents. This is where the big portion of the revenue increases come from. They can do this on existing tenants. You're allowed to increase rents every year by a certain amount. These firms also apply for what we call above guideline increases, which are allowable if they invest in certain major capital repairs. But most profitable strategy is what they call turning over suites, making these suites vacant and then jacking up the rents. So speaking to this particular component of revenue generation, Daniel Drimmer put it this way. He said, the money and returns are made in the suites when the suites turn over. So pursuing tenant turnovers, trying to get people out of their units so that rents can be maximally raised is just a key strategy of these firms. So ultimately, the business strategy of these firms is based on tenant displacement and dispossession, as I've said, and these actions exacerbate patterns of gentrification and the displacement of low-income renters. It also aggravates the affordability crisis that we're seeing in many Canadian communities, just pushing rents sky high in order to deliver these returns. So how did they execute on these plans in practice? Well, as I've mentioned, what firms do is they call their strategy repositioning, in which they transform a building or reposition it in the marketplace to be more profitable for investors. They can do this in a few ways. One kind of general category is just by squeezing more value from existing buildings. This is typically done in weaker markets where you don't see gentrification pressures. And so here, landlords do those things I just described, cutting costs, investing in efficiency upgrades and those types of things. An example here is Cap REIT, which is Canada's second largest landlord. Cap REIT has also expanded into Ireland, I think in 2013. And one of their strategies is to buy aging concrete towers that are in Toronto's inner urban suburbs. So these are parts of the city where if you're a low income renter, that's where you're sort of pushed towards. And there aren't really a lot of other options beyond that. And by increasing rents in those buildings just bit by bit across their entire portfolio, they can drive tremendous returns for their investors. And you also see a lot of evictions in those types of properties. In hotter markets, landlords invest in building renovations and upgrades that will allow them to charge higher rents. And this is what was happening at 200 Dufferin, which I described in the opening. So this approach involves aggressively renovating a building to a luxury style and then trying to attract higher income renters. And just highlighting how this business model is based on displacement, I have this quote here from InterRent Real Estate and Investment Trust. They make this very explicit. They say that they target buildings in working class areas, and then they try to replace so-called undesirable tenants with more desirable ones. So really describing quite clearly their goal to gentrify working class districts. So how is this playing out beyond major market cities? It's not just a phenomenon that's affecting Canada's big cities of Toronto, Vancouver, and Montreal. Smaller cities and towns are a new frontier for financial landlords. In these places, they're drawn to the barriers to competition that exist and this opportunity to monopolize ownership in local markets and then benefit from that monopoly power. There's also been an opportunistic rush to chase growth in resource boom towns and capitalize on the very high housing prices and very strong tenant demand from workers working in these sectors. So really, these types of firms are following growth, economic growth that's based on oil and gas and gold mining. Expansion into the north in Canada has been particularly noteworthy. You got one entity, it used to be called Northern Property REIT, then it was called Northview REIT, now is owned by Starlight. They own 74% of all of the suites in Iqaluit Nunavut and 85% of all the private multifamily rental in Yellowknife, Northwest Territories. So basically like the vast majority of all private rental housing in Canada's Northern Territories. And then showing the reach of financial penetration ever further into new markets, another frontier has been the trailer park. Financial landlords call these recession proof. And here, these properties are basically just squeezed for profits. So there's this case here where rent hikes are being extracted from tenants with no increase in service every year. So I'm going to start drawing some conclusions. In Canada, we're seeing landlords transforming properties building by building into financial assets. And it's really the case that these companies view buildings as assets more so than as homes. So here's a quote from Main Street Equity Corporation. They're saying real estate happens to be the way that they're making money, but the goal here is making money. It's incidental that it happens to be housing. To underscore this point, Cap REIT announced in 2000 on the cover of their annual report, apartments make money. And they say, listen to us, apartments make money. And finally, this is about making money. So this is transforming the industry. Industry watchers note that these vehicles are more aggressive and focused on the bottom line, more so than the old mom and pop owners that were not working in the same way to just extract every last dollar from their properties. But they also note that this is changing how everybody acts. So even non-financial landlords now feel pressure to more aggressively reposition their buildings, or they worry that they're going to face extinction. And then another conclusion to draw here has to do with the ways that this affects tenants who live in the suites that are the key to profit for financial landlords. We remember Daniel Drimmer saying the money and returns are made in the suites when the suites turn over. So with the rise of this new form of ownership, tenants are the ones that are paying the price through evictions, displacement, reduced quality of life in some cases, a growing affordability crisis, and the loss of community if they're being pushed out of their homes. So because of this, suites are emerging as this key site of struggle. And so it means it's a focal point for tenants to fight back and to demand the right to stay in their homes, to fight against rent increases, and to push back against gentrification and displacement. So if we go back to Parkdale, where I started this story, tenants in this community have been mobilizing, fighting against financial landlords, organizing together. In 2017, tenants in Parkdale held a rent strike across 12 buildings for 3 months. Hundreds of tenants withheld their rent, and they were able to win all of their demands that they made of AIMCO, which was a large pension fund that owned those buildings. So I'll end on that inspiring note. Thanks.
Thank you very much, Martine. A fascinating presentation, and a little bit concerning. Well, more than a little bit concerning, I have to say, even though I was somewhat familiar with the Canadian context, just the growth that you document is quite startling. We have, if I may, we've one question in from the audience so far. If anyone else has any questions, you can fire them into the Q&A box down at the bottom of your screen, and I'll read them out to our participants. But the first question we had, Martine, was about what can be done about this, from Adriana Suita. You touched on this at the end, so I don't know if you wanted to elaborate on what, if any, approaches are most effective in terms of contesting the financialization of rental housing. And then I might just throw in a question of my own, because I just think it's really interesting. There's been an extension in terms of the type of markets that have become subject to this type of investment over time. And I don't know, if I just like to hear more about that and how that happened, particularly because here in Ireland, institutional investment is very focused on quite central areas in big cities, or areas of high employment in big cities. But where there has been some signs that suburban locations and areas outside big cities may become areas of institutional investment in the future, which I think is quite significant. So was it the case that in Canada, institutional investment began in kind of core apartments, big city segments, and gradually over time penetrated markets which might have typically be seen as not of interest to financial investors?
Yeah, I think that is the general pattern, but there was, if you look at the timing of it, some of the firms that are investing in secondary and tertiary markets, more kind of opportunistic areas, were emerging at the same time, but the bigger focus for institutions is definitely on major markets, areas with strong population and economic growth. At the conferences that I attend to learn from the people in the industry, this tends to be like the focus of many of the big firms. But then you always do get some of the firms that are like, okay, well, we can't play in that space. We don't have, it's overcrowded. The assets there are very pricey and we can't compete. So we're going to try a different track. So you have some particular firms that have always focused as their specialty on secondary or tertiary markets. There's one company in Ontario that's been doing this since the beginning. They look at markets that are like under 20,000 people in small little towns. And in those places, the benefit they see is that there's huge barriers to competition, and that like lots of the competition isn't interested or doesn't in owning a lot of buildings in lots of different places. But once they get the scale, they find it still profitable to acquire a portfolio that's quite dispersed. And as I mentioned in the presentation, if they can get a handful of buildings in in a town that has like only a handful of buildings, then they've got that monopoly power and they can really influence price levels in those places. And tenants there have no option but to just pay more. And then there's also the example of the Northern Property REIT. Like from the very beginning, they saw huge potential to go where nobody else was going, and just try to consolidate ownership in Canada's North. So different strategies, but definitely most firms are more interested in those big markets. The other question about how to contest it. I mean, this is a $1 million question, really. I think there's lots of different approaches that people are taking. So there's lots of housing advocates and researchers and people interested in this, trying to drive for policy change in Canada. I was interested to see the slide you posted about some of the good policy changes that have happened there. So we can see how so much of this phenomenon was driven by welfare state retrenchment and deregulation. And so there is a temptation to be like, okay, well, if we could put things back or strengthen tenant protections and tighten these things up, then we would eliminate the possibility for these firms to make money from these properties, right? So I think that that's one sort of angle to try to tighten up tenant protections, and to try to affect the ways that these companies make money. And so you're seeing lots of different things happening around the world. Like, for example, in Berlin, there was that recent, what do we call this? Referendum to try to expropriate buildings from huge owners that own more than a certain number of suites, right? So those are looking at some of the ways that we could stop this through policy as one approach. That being said, I think that it's important to fight for that. And there is certainly interest. I think the government is increasingly different levels of government are increasingly seeing this as a problem and are somewhat open to hearing about potential solutions. There's a lot of, I would say, like a jadedness among people living in these buildings about the efficacy of that approach. So you do see a lot of organizers here that say, you know what, we could wait until the end of time and we're all going to get evicted if we're waiting to change policy. So we're going to organize together and use whatever extra legal strategies we can to fight back. And that has been very effective. It's a ton of work on the part of the organizers, but this is why I like to talk about the Parkdale organizers, because they are not putting their energy towards trying to advocate with government or push for policy change, sitting at tables like that, trying to have those conversations while everybody gets evicted from the buildings. Instead, they do things like go to the landlord's neighborhood, post pictures of the landlord on every lamppost, talk about how they're evicting poor people in Parkdale, really put on like pressure in these ways and fight directly with the landlord. So those are some of the strategies that have been working here.
Thanks, Martine. Fascinating stuff. We may take there is a couple of other questions, but we might take our break now, because I see one of the other questions in particular is something we might come back to at the end in our final overall discussion, because it's addressed to all the panelists. So what we might do now is just take a break at this point for 5 minutes. So it's just after 20 to 3 here, which is a different time, obviously, where yous are. So we'll come back in, say, just 10 minutes, and then continue with the second part of today's session. Does that sound okay?
Yeah, so it's 9:42 here, so come back at 9:52.
Yeah, perfect. Okay, thanks a million. See you all shortly to